Welcome to Facts Pro, where it's all about facts, financial, accounting, and tax strategies. We spoke the last couple of times about some advanced tax strategies that involved investments. Some of them were passive, some of them were non-passive, or both, like they could be either or. And today I want to talk more about that concept of having a passive versus non-passive and why does it really matter to incorporate whether it's a passive or non-passive, and what does that even mean for my tax strategy. All right, so let me share my screen and we'll dig in. And I'm pretty sure you're all familiar with the concept of passive income. As you can see from here, it's like basically you're sleeping, you're not really doing much, but you are getting some income that's supporting you. And that's the whole idea of a passive income. So, passive versus non-passive, there is a tax planning opportunity that can save you thousands of dollars. And why am I saying this? Because based on real example of one of my clients, just with correcting the classification of his passive investments, they were passive investments, but he was recording them or classifying them as non-passive on his tax return. Once he switched accountants and came to me, and we were talking about the investments that he has and the key ones he had, and I was asking him the questions whether to see if he would really qualify as a passive or non-passive investment, and I found out that they were passive. So after after correcting this misclassification, it affected him by giving him $100,000 in tax refund this year. So only by doing this one simple change, it affected him and it brought him $100,000 because it released a lot of passive losses that he had from prior years. And this is an issue that a lot of high earners know about, and we're going to talk more about it as we go through the slides. So classification really, really matters because the misclassification means there are missed tax savings, and it has an impact on your self-employment tax, the passive loss limitations, and the additional surtax like the net investment income tax. And it also affects your eligibility for some deductions like QBI. So through proper planning, it can brings you big tax savings. So that's why you need to understand the classification between both. So what's a non-passive income? In simple terms, you need to be materially participating in a trade or business. Common example of it is your W-2 wages. You go to work every day, you report to your employer, you provide work. So whether it's a full-time or not, or a part-time, you're still very actively and materially participating in work. Your self-employment, if you're a medical practice owner, you have your business, whether it's an S Corp, LLC, self-employment, but you're actively involved in the business, then this is considered non-passive income. What is that subject to? It's subject to ordinary income tax. So based on your tax bracket, you will pay income tax on it. You will pay self-employment taxes in some cases. And it affects your QBI eligibility. The QBI is the 20% deduction that you get in some cases on your pass-through income. So when it's a non-passive, you get to have this deduction, which is in the passive case, which is not the case in passive income. All right, so that's the non-passive income. The passive, it's income from activities where you don't materially participate. You just do a little bit of things. You may be just doing like an investment in a limited partnership, or some sort of an investment that you just give a check, and you're expecting to be having income out of that check, but you're not managing, you're not you don't have this decision making, you're not doing any of that. And the common example of it is the rental properties. And rental properties, I have a line under this because It's a big topic. On rental property, some people say, oh, but I do everything for the rental property. I don't have a managing company. I manage everything, but it may still qualify. It may still be considered passive income, even if you are the one managing the rental property. And we'll also talk more about it. What is the passive income subject to? Subject to ordinary income tax, exactly the same like the non-passive. However, there is no self-employment tax, and there's some net investment income tax in some cases. All right. Okay. And also in some cases, QBI deduction. So material participation test. The IRS actually get to decide if you're active or passive. So you can't just say I'm active or you can just say I'm passive. There are some tests and there are 7 key tests. The most common that you need to be aware of is the 500 plus hours of participation. You need to be like substantially all participation, like you'll be the one doing more work than others, especially with 100 plus hours and at least as much as any other person. So no other person is doing more than you are doing. And there are some more defined criteria. Passive activity loss limitation. So when it comes to high earners, there is a passive activity loss limitation. So you can only, just to put this on the table, passive losses can only offset passive income. So you can't use passive losses to reduce like your W-2 income or your active business income. You can't do that, but you cannot use the losses to offset the passive income. That's not the same if it's a non-passive activity. So non-passive, you can use the losses to offset your passive income, but or your passive or non-passive income. But your passive losses, you're not able to use it against non-passive or active business. Passive losses against passive income only. So what if I have a loss that I'm not able to use because I don't have enough passive income? It gets carried forward to future years. With the exception for real estate professionals and active participation in rental, which is the special 25K rule that we will cover in the next in futures, like in later slides. All right, self-employment tax consideration. As we said, the non-passive business income, you're subject to 15.3% self-employment tax, especially if it's a single member, or you pay it on your W-2 if you're an S Corp or C Corp. But the passive income, you don't have self-employment tax. So that's by itself is another opportunity for tax planning. That's one thing we consider when we talk about what kind of investment you need to be involved in. All right. The net investment income tax, this is a 3.8% surtax on the passive income for high earners. So if you're earning more than 200K as a single or 250 as married filing jointly, you get a charge 3.8% on your passive income. So that means that the income type has an impact on of whether you need to pay this or not. So there's also another planning opportunity to manage this threshold. So just to put it on the table for comparative purposes between the non-passive and passive. Subject to self-employment tax, yes, for non-passive, it's a no for passive income. You don't pay self-employment tax. There is a passive loss limitation, yes, because the passive income only you can offset the passive losses against the passive income, but not your active income. Subject to the net investment income tax for the non-passive, it's not subject to that, but yes, over certain limits for the passive income. QPI eligible often, maybe in some cases for the passive income, you may see it depends on what kind of partnership you're involved in or what kind of investment you're involved in and whether it's considered a QBI qualified business or not. Okay, so we said, but there is an exception. What about rental real estate? We said it's by default considered passive income or passive investment. So if I have passive losses, if my rental real estate has been generating losses due to depreciation or due to any of that, can I be using this to offset my W-2 income? And the answer is not really, because it's passive. But there is what's called active participation rule. So is there a difference between active participation and material participation? Yes. Active participation is a lower standard, and the requirements for that, or the definition, that you must own at least 10% of the rental property. You must be making management decision, like you're approving new tenants, setting rental terms, authorizing repairs, and you do not need to spend the 5+ hours that we were talked about in the material participation. So when you have these when criteria apply to you and you have these requirements, then you're allowed up to 25,000 losses in rental real estate that you can use to offset your wages, your business income, all your active income, up to $25,000. But it's phased out when your modified adjusted gross income starts to rise above certain limits. So for high earners, they don't really make use of this, even if they're actively participating. So that's when we talk about the rental real estate loophole, or when you can be qualified for real estate professionals. Real estate professional, to even have a chance at making rental losses non-passive. So again, the standard, the default, that it is considered passive. In order for you to consider it non-passive, you must spend 750 plus hours in real property trade or business. So this is only when it comes to real estate. You have to spend 750 plus hours in real property trade or business, and spend more than 50% of all personal service time on those real estate activities. So including development, construction, acquisition, conversion, rental, management, leasing, brokerage, any of that. So it's both of those options. So not a lot of people can qualify as a real estate professional. And by the way, being a real estate agent doesn't make you a real estate professional. It doesn't work this way, because you have to have both criteria in there. Okay. So the short-term rental loopholes that you hear about in everywhere is a powerful tax strategy, where if you have your property on Airbnb or Verbo style kind of rent, you can treat it as a non-passive, and at the same time you use it to offset your W-2 income without the needing to qualify as a real estate professional. And the key rule here is the 7-day test. The 7-day test is that the average customer stay in your rental property is 7 days or less. Or if it's 30 days or less, but you provide substantial services like cleaning during stay, meals, concierge, or any of that. And if you do not provide substantial services, so if it's Airbnb, people stay there for 7 days or less, and that's it. You don't provide any substantial service. You don't provide garbage collection, any cleaning, any meals, any of that. Then you're not subject to self-employment tax. But if you do start providing substantial services, then it's considered like a hotel-like kind of service, and it's considered to be subject to self-employment tax. So it will be considered in this case as non-passive because it's substantial service, and it will be subject to self-employment. But if you do it as Airbnb or Verbo or whatever, short-term rental without substantial service, then you wouldn't be subject to self-employment tax. And again, just to have it visual comparison between the two options, passive by default, the long-term rental is passive by default for sure. Short-term rental, no, if it is less than 7 days average stay. Real estate professional required for long-term rental, yes, in order to consider it as a non-passive. Short-term rental, you don't have to qualify as a real estate professional. Material participation needed, yes, and yes here for sure. Losses deducted against W-2, usually not. For long-term rental, no. For short-term rental, yes. For subject to self-employment tax, we said no for long-term rental. For short-term rental, maybe if you provide substantial service. All right, so that brings us to the end of today's topic. If you still are confused about whether you're having a passive or non-passive income, if you'd like to talk more about incorporating some passive investments in your tax strategy, please reach out, because that's one thing I have to do. We have to take a look at what you have. Maybe you have a lot of passive losses that are stuck in from prior years, and you just adding one passive investment can release those passive losses for you. So maybe it would be beneficial for you to have one. Or maybe you're not really categorizing the right way, or maybe you can make use of the short-term rental loophole. There are different situations where we can talk more about what's good for you and what depends on your goals and whatever you're looking to achieve. All right, thank you so much, and see you next week.